Here we are in the first lesson of the multi-trader system program. You'll find this program is presented in a user-friendly, interactive, and easily understood language. It's also assembled into a series of what I call the 4 trading pillars to success: markets, method, money, and mind. Plus, 1 bonus lesson with the extra tools and information you'll need to optimize your trading performance. Whether you've never traded the markets, dabbled a bit, or you're an experienced trader looking to improve, this could be the guide you've been waiting for. Every bit of advice, knowledge, and wisdom I've learned since 2003, you'll find in this program. Throughout this journey, you'll learn different trading lessons, strategies, ideas, and tools along the way. My passion and priority with the multi-trader system program is to help show you how to trade for a living using proven and trusted methods with practical and real examples in a clear, understandable, and easy way. This is not an instant gratification and a get-rich-quick program. This is a complete guide you'll need to watch, absorb, and apply to your everyday trading. The multi-trader system program will show you how to bank a consistent income on both rising and falling markets. The first lesson will tackle the first pillar to your trading success, the markets pillar. After lesson 1, you'll be able to understand the trading basics: what, why, where, and how. See why trading is a profitable career choice. Know all the markets available to trade. See how trading and investing are like relationships versus marriage. Differentiate between technical and fundamental analysis. Know the main drivers to profitable fundamental analysis. See why derivatives are special to traders. Understand how gearing is a money multiplier. Know the advantages and disadvantages of trading. Prepare your trading workstation with minimalism. Apply the 2 best financial instruments to trade. If you have a question at any time or you'd like to share your feedback, you can email me at timon@timonandmati.com. As old as mankind is, so is the practice of trading. A simple concept which remains the same today as it was over 10,000 years ago. To exchange one item for another item for the sake of mutual benefit. However, instead of exchanging cocoa leaves for shiny gemstones, today we exchange paper bills in the form of money for a cup of coffee. We are all familiar with the concept of trading as we exchange money for goods and services almost every day of our lives. With trading, you'll buy a market at a low price with the speculation that you'll sell it at a higher price for a profit. Or you'll sell a market at a higher price with the idea that the price will drop, where you'll rebuy it at a low price for a profit. In order to do so, we'll need to ask an important question. How do you know which way the market will go? To answer this question, you'll need to tackle the age-old concept of supply and demand. Let's head over to the farmer's market to see how it works. Dum's fruit stall is known as the best place to buy strawberries. The owner tells you he has 10 boxes to sell. With you being the only customer in sight, the owner decides to sell the strawberries at a reasonable price of just 10 Rand per box. As there is a higher supply than there is demand, you are able to buy them at a low price. The next day, the stall owner arrives with another 10 boxes of strawberries to sell. This time, he is surprised to find that there are over 20 willing buyers lined up. The owner decides to pump up the price of the strawberries to 50 Rand per box. He knows that with a higher demand for strawberries than he has to supply, the buyers will be willing to pay more. This phenomenon is based on human nature with traits such as fear, greed, and ego. You'll find that the supply and demand concept also applies to the financial world. Let's look at 2 scenarios with shares. When a company's financial results come out better than expected, the more people will want to buy the company's shares. This rise in buyers will lead to an increase in the share price. However, if the company's financial results finished off worse than expected, then investors will want to sell their positions, which will drive the share price down. As traders, we can profit in one of 2 ways. Either we'll buy low and sell it at a higher price, or we'll sell high and buy it back at a low price. You can trade just about anything online nowadays, including shares, indices, commodities, currencies, and even cryptocurrencies. Fundamental analysis is the art of buying a market below an anticipated future value. Investors do this by analyzing several financial drivers of the market, such as the financial statements, accounting ratios, company prospects, economic and political factors, changing lifestyles and demographics, income tax rate and laws, industry trends, news, and earnings announcements. Let's move on to the next foundation of analyzing the financial markets. Technical analysis is the other school of thought. If I had to sum up what technical analysis is in just one word, I would say charting. This relies on chart analysis, price data, indicators, and volume that a technical analyst uses to make different probability predictions on the future market prices. Technical analysts use these factors to try to time the market entries and exits using different price charts, oscillators, momentum indicators, volume, patterns, formations, and trends. Please note, in this program, you'll learn a simple breakout momentum strategy with a 62.5% win rate I've used since 2003. With trading and investing, you can buy, sell, and monitor different financial markets. If there was one significant difference that separates trading from investing, I would imagine it would have to be based on the level of commitment. With investing, the relationship is more of a long-term commitment. It's as if the shareholder decides to marry the share. The marriage may either last a lifetime or end up with a content or devastating divorce. With trading, the relationship is more of a short-term proposition. Some relationships will be great and others will be heartbreaking. Most traders nowadays use geared and risky instruments called derivatives. A derivative is a financial instrument between two parties whose market value derives and depends on an underlying asset. The underlying asset can either be a share, index, currency, commodity, or even a cryptocurrency. There are several different types of derivatives you can trade nowadays, including CFDs, spread trading, futures, options, and warrants. The main reason why we use derivatives is because they are a cheaper and a more profitable method to trade the markets. Gearing allows you to pay a small amount of money in order to gain control and be exposed to a larger sum of money. Let's simplify this with a more relatable life example. When you buy a house for 1 million rand, at first, the homeowner most probably won't have the full 1 million rand to buy the house with just one purchase. Instead, they'll sign a bond agreement, make a small 10% deposit, borrow the rest from the bank, and be exposed to the full purchase price of the home. Let's look at how traditional share trading works versus how gearing works with derivatives. Let's say you buy 1,000 shares of Jimbo's group at 50 Rand per share. As a shareholder, you'll need to pay the full 50,000 Rand to own the entire value of the 1,000 shares. In 3 months' time, if the share price hits 60 Rand, your new share exposure will be 60,000 Rand. If you sold all 1,000 shares, you would bank a decent 10,000 Rand profit. When you trade a geared instrument like a CFD, you won't ever have to pay the full value of a share again. A CFD is an unlisted, over-the-counter financial derivative contract between two parties to exchange the difference between the opening and the closing price of the underlying asset. Let's break that down. A CFD, or contract for difference, is an unlisted, where you don't trade through an exchange, over-the-counter, either via a private dealer or a market maker, financial derivative contract, which is the value from the underlying market, between two parties, the buyer and the seller, to exchange the price difference between the opening and the closing price of the underlying asset, which is the market the CFD is based on. Using the example from earlier, you see that Jimbo's group offers the function to trade CFDs. If the initial margin requirement is 10% of the share's value, this means you'll only have to pay 5 Rand per CFD rather than the full 50 Rand payment for one share. With this information, we can now calculate the gearing of the Jimbo's group CFD. With the gearing of 10 times, this means two things. First, for every one CFD you buy for 5 Rand per CFD, you'll be exposed to 10 times more, which is the full value of one share. And second, for every 1 cent the share price rises or falls, you'll gain or lose 10 cents. To be exposed to the full 1,000 shares value of Jimbo's group, you'll need to buy 1,000 CFDs where you'll only make a deposit of 5,000 Rand. If the share price reaches 60 Rand in 3 months' time, your new trade exposure will be 60,000 Rand worth of shares. If you sell all your CFDs, you'll bank a 10,000 Rand gain. Now that we've covered how derivatives and gearing works with trading, we can now highlight the pros and cons of trading derivatives. When you trade using a derivative, you never actually own anything physical. This means you won't have to worry about paying high brokerage and other trading costs like securities transfer tax, stamp duty, settlement and clearing fees, investor protection levy, VAT, and even straight. With derivatives, you can buy a market at a low price and sell it at a higher price for a profit. Or you can sell a market at a high price and buy it back at a low price for a profit. When you buy a derivative of the underlying share, which pays dividends, you'll be entitled to the full amount. There are countless number of markets you can trade with derivatives, including local and international shares, commodities, currencies, indices, and even cryptocurrencies. As you'll only have to pay a tiny portion of the price per derivative, you'll have more free capital to commit to other trading opportunities. On the other hand, gearing is a double-edged sword when you trade derivatives. If the trade goes against you, you could wind up losing more money than what you deposited. That's why it's important to carefully implement the money and risk management strategies you'll learn in Lesson 3. With derivatives trading, you'll need to commit more time to your trades than you would with ordinary investing. If you're an intraday trader, this could range to a couple of hours a day, or if you're a position trader like myself, you'll need to commit to around 30 minutes per week. When you're trading a derivative, you give up the benefit of owning a part of the company through shares. In other words, you won't be able to vote or even attend AGMs. If you sell a trading derivative and the underlying share price pays dividends, you'll be liable to pay the portion of the dividend instead. The best place to start your trading career is by creating your workstation at home. This is where you'll be able to analyze, monitor, trade the markets, and prepare for the next trading day. This will be your safe place where there'll be no external influences distracting you from your trading business. Let's start with your trading room. If you'd like to be somewhat a minimalist trader, the first important step is to find a room away from anything that might interfere with your trading, such as noises from the TV, family, animals, and even social media. Also, you might want to remove any distracting paintings or photos you have hanging on the wall. Next, make sure the room has enough lighting to keep you alert. With just these few tips, I'm sure you will have a calmer and a more professional feel with your trading. With the trading desk, you'll need a comfortable chair with only 2 screens. One screen for your trading platform to buy and sell trades, and another screen to analyze your charts. Next, you'll need to declutter your desk. Make sure that you take off any unnecessary table pieces, stationery, and try to neaten up your desk as much as you can. A cleaner desk will give you a calmer, more organized, and a clear workplace for when you trade. Now that you have an idea on how to prepare your trading workstation, let's get into the 3 essential tools you'll need to set up your trading platform in the next part of the Multi-Trader System program. We've come to the end of part 1 of the Multi-Trader System program. Whether you're a novice or an experienced trader, you're about to learn many new tactics and tips you can apply to your everyday trading routine. With this program, you're about to skip the steep learning curve and avoid paying any unnecessary school fees. Make sure you feel fresh, passionate, and rejuvenated before we cover the second pillar to your trading success. It's called the method pillar. After lesson 2, you'll be able to build your trading system with 3 tools, know which way the market is going with 3 lines, create your ideal watch list with these criteria, identify the best and the most liquid markets to trade. Know when it is the best time to trade. Understand what breakout trading is in a nutshell. Find the strongest support and resistance levels on any chart. Identify the perfect breakout with a 3-step checklist. Place your entry, stop loss, and take profit levels with each trade. Spot 5 profitable breakout patterns on any market. Download the Multi-Trader System cheat sheet to find trades. If you have a question at any time or you'd like to share your feedback, you can email me at timon@timonandmati.com. Please note, if you are not a VIP member of the Multi-Trader System program yet, where you can watch and enjoy the next 4 lessons, you can become a member by going to the link below. Or you can email me your name and number with the words, "Yes, I want to complete the Multi-Trader System program" to timon@timonandmati.com. And I will personally send you everything you need to continue with the program within 24 hours. I'll see you in lesson 2.